Hello and welcome back to the Project Management PrepCast and to part 2 of the lesson on advanced cost theory, where we give you our 2 cents worth. Well, I hope it's more than 2 cents. I'm your instructor, Cornelius Fichtner. In part 1, we covered some financial language, cost types and opportunity costs. And now in part 2, the fun continues as we sink our teeth into sunk cost, talk about discretionary cost and explore business value. Don't worry, just because we start with sunk cost doesn't mean you will be in over your head. Well, I hear sunk cost and I imagine something like this here, a vessel wrecked and tumbling in the ocean. Not really. Instead, according to Wikipedia, sunk cost is cost that has already been incurred and cannot be recovered. What's important here is the fact that by including the words already been incurred, sunk cost is in the past. We are after the fact. Another fancy way of saying the same thing is that it is the retrospective cost. The second point is that the funds cannot be recovered. If you are able to dispose of an item and get value in return, some cost is recovered. The value could be in the form of money or another benefit, but sunk costs cannot be recovered. Here's an easy to understand example to clarify the concept. Assume you bought a car 5 years ago for $20,000. You have kept track of the maintenance cost that you have incurred. Tires, gas, oil changes, tune-ups, car washes and so on. You've spent about $8,780 on that. A few things have been breaking down recently, costing you about $300 each time. The additional bills have now made up $1,500. So, although you have spent a total of $30,280 on the car, you know you cannot recover all that money. Your car now has served for 125,000 miles, and it only has a resale value of $5,100. That is your recoverable cost. The total expenses minus the recoverable value, that is $25,080. That's your sunk cost. But the only number going forward that matters in buying the new car is the $5,100. That's what you can get for your old car. You ignore the sunk cost. In this example, it makes sense that the sunk cost is money that's gone. To relate this to project management, we turn back to the data center example from part 1. Assume there is a huge economic downturn partway through this project and your bosses want to revisit the decision to build or outsource the disaster recovery operations. You are charged with coming up with the analysis of what to do. First, you need to figure out where you are at in the project. The building is finished at a cost of $300,000. The computers are installed. That cost $250,000 in hardware plus $200,000 in labor. The software is about 1/3 installed and configured. You have spent $120,000 in software and $100,000 in labor. The power and data services have been pulled into the building at a cost of $85,000. The 5-year commitment to buy services at $4,000 per month has not started, and you have not hired the people to run the data center. All in all, you're very proud of the fact that the project is on schedule and on budget, and it's very frustrating to have to do this exercise and tally up all the numbers, thinking that they might throw away all your great work because of the economic downturn. So you create a spreadsheet to track your numbers. At first, you want to put a price tag on the value of your data center at $1,055,000. So you enter that number. After all, it's what you see the company has invested. $300,000 for the building, $450,000 for the computers, $220,000 for the software that is installed to date, and $85,000 for the services that were pulled in. However, you read that sunk cost needs to be ignored. You start determining what you can recover by selling what you have bought and built. Because the building is so specialized, finding a buyer to pay you $300,000, that's improbable. You have an assessment done and find out that the market price is about $180,000 US. Used computers, very little value and are worth only about $80,000 on the market, and the labor expense has no value at all. The same is true for the software, and out of the $120,000 you spent, you might be able to recover $40,000. Unfortunately, nobody who buys the building is going to see value in the massive power and data services that you have installed, so they have no value. You add up the values of $180,000 for the building, $80,000 for the hardware, $40,000 for the software, you get $300,000. Somewhat depressed, you add that number up in the top right corner of your spreadsheet, right next to the $1,055,000 that you have spent. You pull out the original report and check with the outsourcing company about whether they will honor their old bid. They say yes and send you an updated copy. You start a new spreadsheet. Option 1 is moving forward with building the new data center. The remaining cost for the project to complete is $440,000. The first year cost of operation is $264,000. Your bosses want to know and include the first year cash expense. That is the executive team's primary concern. So that's a total outflow of $704,000. However, the benefit still exists for increased revenue, so we take $180,000 out of the cost. The net outflow to complete is $524,000. For the second option, outsourcing, the numbers look like this. Startup costs are $150,000 and the first year costs are $504,000, giving you an outflow of $654,000. However, we can recover the $300,000 from selling the facility. Remember, we're not using it, we're outsourcing here, and that results in a net cost of $354,000. Well, it is now up to your bosses to make the decision. You have provided the data here that they need, and it does point to outsourcing as giving them the better deal. However, you have learned a lot since you see that a lot of the money you have invested in your project, the sunk cost, has no bearing on whether to keep your project moving forward or not. It's also important to see in this particular case that the recovery cost of $300,000 there on the right-hand side benefits the alternative selection. The larger this is, the better the alternative option looks. Just imagine if the recovery cost were $600,000, then the net there would be $54,000. Your bosses decide on the future direction, and you supply the objective data. You're probably not pleased with the numbers because you know it's likely that your project will be cancelled and you will need to do the disposal work. You may be familiar with the next couple of terms from the nightly news or reading about them in the news. These are mandatory and discretionary costs. These are terms used to describe types of projects rather than costs inside a project. Mandatory costs, often called mandatory expenditures, like the name implies, is money that is spent on items that must be delivered. It's not saying that a specific amount of money must be spent. You still have a fiduciary responsibility to perform the most cost-effective delivery. It is often used when talking about government spending. Mandatory spending denotes money to provide mandatory services according to a law. Social Security, for example, Medicare, veteran benefits are about 90% of mandatory spending here in the United States. If you put this in personal terms, your personal budget has items like food, power, house payment, rent, phone, which are usually considered mandatory. If you don't pay for them, bad things will happen. You lose your house, car, you starve, or worse. Projects defined as mandatory are compliance projects that implement new laws or rules that the company must follow. In the United States, these could be for Sarbanes-Oxley, Securities and Exchange Commission rules, the SEC, equal employment opportunity rules, and similar laws. In Europe, it's the Data Privacy Acts that are very big at the moment. Maybe it is to comply with a standard that defines a line of business for the company. Many companies have dozens of standards that they must comply with to stay in a particular line of business. Examples are ISO compliance, the electronic data interchange standards, and the like. On the other side, discretionary spending is done voluntarily and, in that sense, the opposite of mandatory. These are general improvement projects. In government, it may be spending money to repave a road or landscape a park. It is something done that is not required by law. In our personal lives, it could be going out to dinner, buying a second car, or even cable television, although these days it may seem mandatory and people can't seem to live without it. In business, these could be projects to implement new processes, or maybe to develop new products. These are projects that may increase profitability, but are not mandatory. In tough times, discretionary projects usually get less attention than mandatory projects, to the point of discretionary projects actually being cancelled. These two terms, however, are not used to describe cost inside projects. If you think about it, all costs in a project except reserves have been tied to deliverables. In that respect, those are mandatory costs. They are being spent to provide the product, service, or result that your project has undertaken to provide. The expectation is that your budget is needed to produce your project scope. You do not have to spend all your budget, but the money that you spend is on mandatory items. The only place a cost can be considered discretionary is when we are addressing unknowns, reserves. The project manager has some discretion on how to mitigate risk and how to deal with contingency. If we feel that team morale is hurting, then we can use the reserve attached to a risk on morale to take the team to lunch or something the like. Or if we feel that an opportunity can be exploited, say providing free resources to the project, then taking a stakeholder to lunch might be at our discretion. However, if there is no risk associated with the expense, there is no money available to the project manager to use, the risk must be associated with an appropriate contingency reserve. It is key to remember that these terms usually describe the company's cost of running the project, not the project cost. When we were talking about some of these terms, specifically opportunity cost, we have used the word value. Value is not profit. Value encompasses a lot more. The PMBOK Guide's definition of business value is that it is the net quantifiable benefit derived from a business endeavor. The benefit may be tangible, intangible, or both. It's important to note that the value must be quantifiable. If stakeholders cannot put a number to value, it's not considered. You could have business value from invoicing a client, or maybe through a reference that could help land a second contract for $10,000. As these two examples are quantifiable, they have value. On the other hand, if a client has the same social goals as your company, it's not value unless you can quantify it with a number. If you cannot, it is excluded from determining value. In addition, value includes both tangible and intangible benefit. Allowing intangible benefits is often confused with undefined value. It's important to remember that value requires being quantifiable, regardless of its tangibility. The benefit must be able to be defined. The financial tools we learned about are instrumental in determining value. They help quantify benefits objectively. Value analysis seems like a relatively easy concept to understand, but can get mired down with intangibles. The idea behind value analysis is to first examine the project deliverables and other benefits and their associated costs. It could be that you need to look at items other than deliverables. The next step is to assign a value to these elements. This process can be carried out to the level of each feature and function that the project is delivering. You then try and decrease the cost of each of these items without reducing your scope or over-analyzing the requirements with the goal to produce the component in the least expensive fashion. The result is the best product at the lowest cost. The enemy of this process is time. The longer you analyze the options, the higher the cost. The longer it takes to produce the product, the longer you miss its benefits. You need to decide to move forward, otherwise your lost opportunity cost negates any value. As part of closing this lesson, it makes sense to go through a couple of sample questions on advanced costs theory to see how well you picked up on the topic. We start with an easy one. What best describes sunk cost? Is it A, unrecoverable cost, B, mandatory cost, C, fixed cost, or is it D, bad opportunity cost? I bet you've already spotted the correct one, right? I'll still give you a few seconds to think about it. Maybe second guess what you had thought about. If you need more time, please press pause. All right, the correct answer is, of course, A. Sunk cost is money sunk into the project that cannot be recovered. A sunk cost is a past cost that has already been incurred and cannot be reversed. And here is question number 2, a little harder and a little longer. A company has decided to use some idle land that it owned to build a new facility, when they could have sold the land for a huge sum or for less profit. They could have rented it. What is the opportunity cost of using the land for the new facility? Is it A, $0, since the company already owned the land? B, cost of the new facility? C, market price of the land? Or is it D, the net present value, the NPV of the rental income? All right, as always, I'll give you a few seconds to think about this one. You may want to press pause and take some additional time here. Are you ready? The correct answer is C. The land, although the company already owned the land, is not a free resource to the project that is building the facility. Using it implies incremental costs. Building a new facility means that the company gave up the opportunity to just straight out sell the land. Therefore, the correct answer is C. The market price of the land is the opportunity cost of using the land to build the new facility. In closing, here are the takeaways from part 2 of this lesson. Sunk cost is money that has already been spent and is non-recoverable. This is actual money, and since it is non-recoverable, it is gone and has no bearing on future considerations of what direction a project should take. Often people include sunk cost. In economic terms, this is considered emotional or irrational. 2 other classifications of spending that relate to projects are discretionary and mandatory costs. In general, these 2 classifications apply to the project as a whole. Is the project mandatory or is the project discretionary? Inside a project, discretionary spending is in the form of contingencies, reserves, and mitigations. Lastly, value is any quantifiable benefit, whether it is tangible or not. With that, you have what you need to know in regards to the ins and outs of advanced costing. Until next time.